Hey guys, welcome to my channel Emerging World Order 2025, and in this video we're going to talk about price control. This is going to be a very interesting video. Please do like and subscribe because it helps me and you don't lose anything by subscribing and liking. You like, then algorithm picks up. It helps me grow. Okay, so please do like and subscribe. Please. And now, so you guys might have heard President Trump talk about tariffs. What exactly tariff did? His take on tariff is this. His take on tariff is that he says that China, India, and there are lots of countries, even Canada, Mexico, all these countries, what they're doing is that they are abusing or taking advantage of US system. And this creates a massive trade deficit for US. So what happens with the tariff if he applies tariffs? He's saying that if you don't fix this balance of trade problem or trade imbalance problem, I'm going to apply tariffs. So what exactly happens when you apply the tariffs? Lots of you will say, yeah, price control, price will go up, this, that. But what happens with the price control, right? See, what happens with price control is this, that there will be selective tariff on certain products. So let's say trade imbalance is negative for US $150 billion. So what US is going to do is that US is going to calculate those products that will have least impact. If they leave the US market, then US will have least impact. Why? Because there are other alternatives available. And least impact, and then if you calculate the whole entire sum, probably that's going to come, it will all add up to $150 billion or close to it. So they're going to continue to apply tariffs on selective products until that balance of trade becomes zero or it is close to it, meaning that they will leave a little bit of $10 billion like that, but the rest they're going to hammer it. Meaning what he's saying is that, hey, China, if you don't fix this problem, then we are going to forcefully fix it. And we will do it from our side. In that situation, your product is going to lose our market. Okay. So what he asked for this thing from US, or actually from China, is that don't manipulate the prices of our product in your market so that your products can stay competitive in your local markets. What do we see here? Price control. Then if you start to look at geopolitics pretty closely, okay? If you start to see the geopolitics very closely, you will find that it's all about the prices. One way or the other, directly, indirectly, everything comes down to one thing and one thing only, that is prices. What is the price? Why? Because you do trade. Trade is all about price. Cost price, selling price. Cost price minus selling price minus cost price determines the profit. And you add some risk factor here and there into it, then to do the future or other calculations are done, right? So this is why if you want to understand geopolitics, then it's very important to understand how pricing really works. Look, for example, before I say a lot more, let me ask you a simple question. That a farmer grows some vegetables. Farmer grows some vegetables or grains or whatever. Let's go with grain, okay? Let's wheat. So how does farmer know for that, yeah, this is how much I should get for it? And then what happens to that wheat from the middleman who buys the wheat from the farmer? What happens to that? What happens after that? Where does that wheat go? How does it reach the market? These are the questions you have to answer. You have to find out the answer to. Or let's go with today's video is all about oil prices, okay? So today's video is all about oil price control. Now let me ask you a question. That US has, in the Permian region, has the largest oil deposit in the world. Okay? Largest oil deposit. But why US doesn't export and all that? Why is that? I mean, after 2020, US didn't export it. In fact, pretty much all the refineries were shut down. So the ExxonMobil, Shell, Chevron, all these companies that you see, they are all offshore drilling companies. They don't drill onshore like in the US market. They don't do that. Permian region, nobody does that. Alaska, I will have to check the Alaska pricing and all that, how that works in Alaska. But nothing here in Texas. No, they don't. Very few do it. But that's about it. So the real question is that why is that? Why they are not able to do it? Don't you think that it will be a lot easier if they produced it here, and then you can easily control the market and boom, everything is cheap for us? But that doesn't happen. There's a reason for it. The reason is pricing. Pricing once again. What is inflation? Inflation is also what? Pricing. Now, if you think the price, if you want to underestimate price, if you really want to underestimate price, then I would say go talk to Kamala Harris. That's all I got to say. She lost election. Price. Okay? In India, Prime Minister Modi, he almost lost election because of what? Prices, inflation. Look at China. What's the situation in China? China, that's known for keeping the prices low for cheap products. So cheap that people don't even want to repair it. But China has very high inflation right now. Look at Japan. Pricing. Okay, pricing. But each and every place has a different reason for their inflation. The pricing. So today we are going to talk about the oil pricing, ladies and gentlemen, and let's get started. Okay, I'm very excited because I wanted to make this video for a very long time. I've been wanting to do it. It's just that lots of ideas come, and I know this is a very grand idea because this is going to be like I will have to make 4 or 5 videos in this series, because today I'm going to talk about oil prices, then after that grain, then metals, precious metal, gold, platinum, silver, all that. Then semiconductor pricing, lithium and all that, how lithium prices are controlled. Think about it. Then above all, how uranium prices are controlled, if I ask you. In fact, how uranium market is controlled. Think about it. Now you're getting into the geopolitics of it, okay? The moment you talk about these critical things, immediately geopolitics shows up. If you really want to understand geopolitics, always look at the market. What do? Go look into the energy sector, go look into the semiconductor sector, go look into the food sector, go look into the oil sector. Energy is oil, but go look into it. Look into all that. Look into water and all the water supply, utilities, pricing of all that. And you will learn a lot about geopolitics, and you will predict everything so accurately that you will be surprised by yourself. Okay? This is why when I do things, when I say but tell you like this is going to happen, that's going to happen, and it happens. Okay? It happens. And it happens because I talk about the numbers behind it. Okay. So once again, see, last year I made a video about explaining why US and Russia why President Trump is talking about removing sanctions from Russia and having good relationship with Russia and all that. I explained all that. Then I made video about why President Trump is talking about why they're all meeting in Saudi Arabia. Why Saudi Arabia is the mediator. Think about it. I made all those videos, and exactly word by word, that's exactly what was the conversation behind closed doors. Word by word. There is a reason for it. Do you know what the reason is? Prices. Okay? Let's get started, guys. Let's get started. Enough of all the background I'm building. All right. But this is very interesting video. So please stay with me till the end. All right. Please do like and subscribe. And there you go. Geopolitics of market control. Who controls oil prices? Before we go forward, let's see. I'm going to show you something why I'm making this video. Actually, I've been wanting to do this for a long time. It's just today, Farooq actually gave me the reason. So what Farooq says, let's look at that first of all. Farooq is one of the subscribers, and he says that I'm a very devoted fan of your channel. Thank you, Farooq. Fan of my channel. Okay, you discuss with understanding geopolitics. If you can make a video of who determines the prices of commodities for the BRICS countries, most especially crude oil, since the price is set by an international regulator of the global West. Thanks. Wish you more knowledge and growth. Thank you, Farooq. And thank you for this wish. I think this is the best wish anybody can give, that wish you more knowledge. And this is exactly what I am sucker of. I love learning day in and day out. To make one video, you guys don't know how many weeks and months in advance I read about things. But I do read them. And I never make videos based on the trend. One thing you will note about my videos, I never make videos based on trends. I make videos based on what I find interesting, a real genuine question that will address our current things. Okay. And thank you for being a fan. And if you guys notice that we do all these things, right? I make all these videos, but we normally don't realize that somebody out there is benefited from it. And when I find this out, then it just humbles me. All right. It just humbles me and it wants me to do better. So thank you, Farooq. And this one is for you. All right. So let's get started, guys. Now, oil prices, the geopolitical chessboard. It is a chessboard. Okay, it is a chessboard. Whatever is happening in Africa, for example, all the mines, the children are getting exploited. The mines are getting exploited. There was a indirect colonization of Africa by French and Western powers, and then some more here and there. But now it's going away slowly and slowly. It's gone for the most part. Why is that? It's because of prices. Because you want to keep the prices down. That's why it is a chessboard. If you don't believe this, go to Africa. You will see that thing. Look at Mali, Sudan. Russians have taken over Sudan. Now they have a port over there in Sudan. They got a naval base in Sudan now. Think about it. These are all the chessboards. This is the political chessboard that we are playing a game here. All the corridors and everything, it's all calculations, chessboard. Why is that? Why Russia didn't like? Why Russia even hammered Ukraine? Why is that? Prices, directly, indirectly, it's prices. Directly, indirectly, it's Mediterranean. Directly, indirectly, it's Black Sea. Just remember, Russia used to be part of G7. It was G8. That's how they learned the plan. Okay? But that's a different story. Let's get here. But point is prices. I'm just trying to explain how geopolitics really works. Okay. Now OPEC and OPEC plus production cartel. That's one entity that controls it. Then other entity that controls the prices are Wall Street speculation, the financial traders. Then third thing is the petrodollar system, the US financial controls. And then government sanctions and strategic reserves control the oil market. These are things that control the market, and I'm going to talk about each and every one of them individually. Okay, so don't run away. And and let's see. Yes. So OPEC and OPEC plus. See, when it comes to OPEC and OPEC plus, then OPEC countries, mainly the Gulf countries. Let's go with Saudi Arabia example. All right. Most of the Gulf countries, the GCC, uh, they have this thing. They have this problem. Okay, they have this problem, and that problem is of commodity problem. What do you mean by commodity problem? Commodity problem meaning that most of their economy is dependent on oil export. Okay, so for example, Saudi Arabia. If we take Saudi Arabia example, then Saudi Arabia's oil export constitute pretty much, I would say, 90% of its GDP. All right. So if you want to have let's say if you want to have a $90 billion or $90 GDP, let's not talk about billion, but otherwise you'll get scared. Okay. $90. If Saudi Arabia wants its GDP to be $90, then they will have to sell, at least they will have to earn those $90 by the oil sale, and rest 10, if you want, they can do it from somewhere else. But that $90, they basically set up the price that, okay, this is our GDP, let's say, is $100, out of which $90 we will use. $90 GDP we are gonna earn by selling the oil. Okay, that's what they do. They say that, okay, this is how much, so this is how it's gonna be. That's how they price their oils. But so there's one thing that I want to tell you. One thing in Saudi Arabia, or pretty much any Gulf country, that when you produce the oil, okay, the digging the oil, the drilling it, actually the level of oil is not that deep over there. Okay, since level of oil is not that deep, so what happens is that the drilling cost is really, really cheap. So meaning that if you go drill, then production cost will be probably $8 to $9 per barrel, give take. So now you're like, so why all of a sudden, why oil is so expensive if they are selling it for 90 barrels? And Saudi Arabia, recent that Saudi Arabia has been doing is it's up to $90 per barrel. That's how much they've been selling their oil for. Okay, maybe they may give concession here and there to their partners, and depending on the trade relations and all that. But in general, Saudi Arabia sells the oil at around 90, in that range, $90 per barrel. And then rest, they in their budget, they show a deficit. So lots of you will be like, oh, they sell for $90 per barrel. So if they sell for $90 per barrel, then the real question is that, so is the profit what, $80, $80 difference? No, actually not. See, what happens is that there is a price, the term in the oil, even though you can find this word in English also in dictionaries, but in the oil industry, it's called break-even price. What is break-even price? Break-even price is different for different countries, different sellers. Okay, like for Saudi Arabia, the break-even price is $90 per barrel. Why is that? That's because Saudi Arabia uses that oil to export and to establish its GDP. So Saudi Arabia basically takes its entire GDP into account before when they set the pricing of the oil. Okay, when they sell the price of the oil, and they take the whole entire GDP into account. Okay, and based on that, they set the price to say $80 per barrel or $90 per barrel, depending on how much they want their GDP to be, and how much deficit they can handle. Okay, now, and this is one reason Saudi Arabia and pretty much every Gulf country nowadays, they are all diversifying their trade. Why is that? They're diversifying their trade because first thing is that there are too many players. Second thing is that as you drill the oil, what's happening is that oil well, or the level of oil and in the ground, underground, it goes down, down, and down, right? Eventually, what's going to happen is that instead of $8 or $9 per barrel, the cost of drilling will be it's going to go up $20 or $30, or it could be $40. It may not be as expensive as US or Canada or somewhere else, but Saudi Arabia won't be able to use that $90 per barrel break-even price for its oil. Why? Because majority of it, right? If it's $30, right? If the drilling cost and everything is $30, and Saudi Arabia sets the break-even price to $90, then what's the profit margin here? What's the GDP? $60 per barrel is going to determine this GDP, meaning that overall GDP is going to shrink. So GDP will shrink. What does that mean? Saudi Arabia's economy is going to suffer, right? So this is why Saudi Arabia and other Gulf countries, UAE and all that, Bahrain, UAE, Qatar, they're all diversifying their export now. Okay, they're investing in different other countries. They're trying to invest in infrastructure. They're doing different other things so that they can, instead of $90, so the difference that is there, right, when the oil prices are gonna, the whole difference won't be there, then they're gonna make up for that difference through these diversified exports. Okay, now you get the picture. Now, so now mathematically, if you look here on the slide, production quotas, market assessment, and then price targeting. They look at the production quota. OPEC members agree on how much oil they will produce. If they reduce the production, oil supply tightens and prices rise. And how much oil they will produce, that is determined by their GDP, their break-even price, all that. Right? For example, I will give you another example. How they determine how much oil they're going to produce. Right after Russia-Ukraine war that happened, Russians started to sell their oil way below the break-even price. For Russia, break-even price is around $70 to $75 per barrel. And just remember, Russia also takes into account its GDP as well, because Russia wants oil export to contribute to its GDP. That's what they want. So what they do, their break-even price is like 70 to 75, even though drilling cost is not that much in Russia either. So 70 to 75 Russia does, but Russia was selling oil at how much? $65 per barrel. $60 to $65 per barrel they were selling to India and to China. But what they did to make up for all that, so that their GDP constantly grows. Russian GDP grew by 4.1% last year in 2024. Just remember this. So what happened? They increased the oil production. They increased the oil production to make up for the break-even price. All right. So what they do is that they want to keep the oil. So they keep the break-even price higher so that they don't have to produce too much oil. All right. That's the idea here. But that's how they determine the production quotas, how much they're going to produce. Okay. And then market assessment. Market assessment basically is global demand and all that. How global demand is calculated? Global demand is calculated from the data, previous year data, how OPEC actually, when OPEC sells the oil and all, they get this data from their business partners, different countries. So let's say if Saudis are selling oil to India, then what Saudis are going to do is that Saudis are going to ask India to, hey, what do you think will be your demand for next year or the year after? All those things. So in that situation, what happens is that uh, they know the demand, and that's how they adjust their production. That okay, India will do this much. India's demand is growing this much. Then China's demand is growing this much. US demand is growing this much. So we will have to increase our production this much. And we'll have to, so this, because of this, if we increase the production, then let's see how we're going to calculate the price will be calculated based on GDP and all that. They will set that price, and after the calculation they will decide that, yeah, this is how much they're going to sell it for. But I'll talk about the formula and all that later on. But now you understand that it's all about the break even price that they keep for their based on their GDP, based on their risks, they based on anything else, other factors. There are different things. Now let me get back. What happened with the US during the Russia-Ukraine war? In fact, during the Joe Biden administration, last administration, what they did, they totally stopped drilling. Okay, when they stopped drilling, so they were asking. First, Joe Biden asked Saudi Arabia to lower the production, decrease the production. He asked. The reason he asked to decrease the production was not because of Russia-Ukraine war and he wanted to hurt Russia or whatever. No, it was not that, or petrodollar or something. No, he asked to lower the prices because one of the many reasons is that US break-even price, which means that the cost of drilling oil in US it involves fracking and all that. So it is the break-even price allows 70 to 75, meaning that if they sell the oil at $75 per barrel, then they will break even, meaning that they won't have any profit, but they won't be taking the loss. But anything below that, meaning they're going to take the loss. All right, that's why it's called break-even price. So he was asking Saudi Arabia to decrease the production. So this oil prices are going to go up. So at least in US, if it goes up, so let's say $80 or something, then at least those companies will be able to drill here. And this way he can somehow curb the inflation that was going to happen. All right. And also they will use that thing to sell oil to European Union as well. So that to hurt Russia in the process, like that. But Saudis said that no, we are not going to do that. Why? Because if Saudis do that, then it's going to hurt their economy. Why? Because all those things, all those oil, how much oil they're going to produce and everything, supply and demand, all that is calculated in the first quarter of the fiscal year, so that that's how they start to produce for the rest of the year too. Okay. Now, if they change, then it hurts the Saudis' economy too, right? So they didn't do it. And then when Russians started to sell it at 60, 65, India started to buy from them, China started to buy from them. So US couldn't drill its own oil after that. That's why inflation went up. And now coming back, this is why President Trump wants a good relationship with Russia, so that at least for his tenure, for these 4 years, Russians will keep their price above this break-even price of US. So if US has $75 break-even price per barrel, then they will ask Russians and Saudis to keep it above 80, 85 like that, so that they all make their money. 80, 85 around that, they will all make money. Because it's energy, everybody wants it, regardless of the pricing. So US can at least drill. So when US drills inland, then what's going to happen is that it's going to bring down the inflation in the country too. Okay, because energy prices are going to come down. All right. So that's the whole idea. That's why he wants to have a good relationship with Russia. Why? Because otherwise what they did is that between 2014 to 2020, during that time frame, they had almost killed the oil industry in the US. Russians have brought down the oil price to $30 per barrel. $30 per barrel. Go figure. Goodbye drilling. Goodbye drill, baby, drill. All right. So that was all goodbye. Anyways, so going back to it. So up until now you understand the concept of break-even price. Okay. And what are the things that are considered, taken into account before making the pricing determination, right? So, and we talked about this thing too, right? So future prediction on this is that, one second, that a BRICS oil pricing mechanism. So now to answer Farooq's question, Farooq said that how BRICS countries are going to handle this. See, BRICS countries, this is why BRICS countries are right now, they're trying to bring in each and every oil producer that's out there within the BRICS fold. Exactly like G7 did back in the day. G7 was formed to basically counter any kind of embargo, any kind of oil price fluctuation and all that. Like it happened in 1973, right? In 1973, oil embargo happened and Western countries didn't know. There's something here is bugging me. So Western countries didn't know what to do with it. That's why 1975 BRICS, G7 was formed. Okay. And so BRICS has learned its lesson from it. And this is why they are inviting everybody into their fold and down the line. So what's going to happen is that probably BRICS is not going to create any other separate exchange. I think then OPEC prices will be for price determination will be, how do I say it? All that will be done by taking into account the GDP of BRICS countries. If you look into why is that, why I'm saying that. So pay attention because this is very important. Once again, like I said, pricing determines the geopolitics. Okay, you have to understand this thing. See, Saudi Arabia and other Gulf countries, what they want, they are diversifying their exports. Where are they going to diversify their exports? They're going to India, they're going to China, they're going to US also. Then they're going some other countries, Australia, maybe some other countries, but these are the major players. They're going in these countries to invest. So which means that their investment is going to grow in these countries. So in future, when they will determine the oil prices, they have to make sure that GDP of these countries is also taken into account. The market of these countries will be taken into account. Why? Because that's how they're going to make the money, because they're going to invest. They're investing in their infrastructure. They're investing into different things, right? So they have to take that into account down the line. Okay. So Saudis are not part of BRICS right now, but if they become part of BRICS, then that's how it's going to play out. All right. And so down the line, I think as time goes by, then probably we will see the BRICS pricing mechanism too. We will see all that sooner or later. Okay. But for now, there is none right now. BRICS has to rely on OPEC. But see, the thing is this. A country like Russia, who is a global power, great power, countries like Russia, you don't dictate your price or anything to them. They started to sell the oil way below the break-even price, so much so that G7 got scared that, hey, so they were trying to put a price cap, and Russians were like, nobody gives a damn about your price cap. Why? Because you don't sell oil. If you have to sell oil, then come on, get in the market. The problem is that G7 countries like Canada and US and all, they cannot produce that much oil that fast into the market. So they can compete. That's the whole thing. Okay. So now you see how pricing relates to the geopolitics. All right. Now, The second method is, first we talked about OPEC, how OPEC controls the pricing. Now, second is the futures trading. What is futures trading? Futures are standardized agreements to buy or sell a specific quantity of oil at a predetermined price on a set future date. What does that mean? See, I'll give you a simplest example of this is just to understand, okay? Just to understand is that interest rate. When you go buy a house, then what do? You lock in your interest rate. Interest as in, like, say today you say that, okay, interest rate is 3.6%. Then 90 days from now, you don't know what will be the interest rate. It could be higher, it could be 5% too. So what do? You pay a little bit of extra money and you lock in that price, lock in that interest rate for to buy the house 90 days later in future. Okay, that's what happens here in this case too, meaning that what do? You go to key exchanges like Brent, Crude, or West Texas Intermediate and all that. These are the two exchanges that determine the future trade. Okay, where you go and you put the money on it, and they say that, okay, we will buy these things for 6 months from now. We are going to lock in this price. So lots of countries do this thing to lock in the prices, using it as a hedge or something, to manage their risk. And I will explain to you what exactly all that this means. See, the question really is this. Real question is that how the price, that is how the trading here in these exchanges, how the trading in these exchanges actually determines the price in the actual market. That's the question, right? So what happens is that happens based on the oil producer investments, right? Oil producers, they register themselves into Brent, Crude, or West Texas Intermediates and all that. And from here, what they do, they grab the money, right? Here they sell their bonds, their securities and all. They sell those things here in these exchanges. And depending on how much the securities are selling, how much their bonds are selling and all that, then the prices are determined. And in some cases, there is a spot pricing. Spot pricing is meaning that you buy the oil then and there with that price. Okay, spot pricing is done like if you really want to buy it and then go and take it and trade and then sell it somewhere, like India did. India bought oil from Russia at a spot price. Okay, spot price was $65 per barrel. India bought it for $65 per barrel right then and there, and then they started to sell. So what happened? But from India, European Union bought from India at a future contracts, meaning that India said that, okay, we are going to sell you at around 75 or 80. So how do you do that? You say that, okay, we are going to do it via future contracts. And that's exactly what they did. Now you understand what I'm talking about here? Yeah. So the bodies here are Brent Crude. This is the ICE. This is based in London. And then you have West Texas Intermediate. This is traded on the New York Mercantile Exchange. Okay, a part of CME. What is CME? CME is Chicago Mercantile Exchange. So this is where you just like you have New York Stock Exchange for company security, different other securities, right? Same way these are for commodity securities. There are different bodies. Okay, and then there is a future contract, future trading also. Then there is foreign trade. So there's a currency trading happens. So currency trading, just like a stock happens, right? You buy low, sell high, right? So that's exactly how you have to treat everything. Then what is US dollar's role in oil pricing? So US dollar's role is it used to be the case back in the day when petrodollar was dominant. After the Cold War, especially the petrodollar became very dominant thing. So just like I said earlier, that when Russia-Ukraine war started, they said ask the uh, Saudis to lower the production. They wanted to lower the production so that they can to control the post-COVID inflation and also to hurt the Russian economy, right? That's how the pricing is controlled. So, and oil is traded in dollar everywhere, but now that's not happening anymore. And but oil used to be the purchase in dollar. I mean, so the oil purchase in dollar was the primary means to recycle the dollar in the global market. Okay, dollar gets bought. I mean, oil gets bought in Saudi Arabia in dollar. That dollar gets invested into U.S. Treasury, and then that Treasury basically money goes into U.S. markets here and there, and it would come to US markets, investment would happen and all that. But slowly and slowly what happened is that thing stopped. And so that's why it started to hurt the economy. The corrupt politicians, bureaucrats, they started to rely more on printing the money rather than actually following the economics. Okay. So US benefits financially because global oil trade strengthens the dollar's dominance. We have talked about this one too many times on this case, right? But consequently, BRICS nations move to trade oil in local currencies. That's happening, right? So the whole national currency trade, local currency trade is actually hurting the dollar. Especially, see, petro yuan and all, I don't think it only captures 4 or 5%, or actually maybe 15% right now. Like India's rupee is like 5%, like that. But that's not going to hurt as much as trading in national currencies is going to hurt. Okay. And this is pretty easy to do, and it's happening all over. All right. So this is why, this is another reason that President Trump wants good relationship with all these countries. Their tariff and all that is there. Those are business talks, and which is only reasonable, right? Because you want that trade deficit gone. So what happens when you cut that trade deficit? What happens is that you actually improve your currency. You are cutting back on things. Why? Because you are buying unnecessary stuff that is not even needed. So $150 billion trade deficit, meaning that US is paying China $150 billion extra for no reason. That's like a saving. So that's why all these things are done. Pricing. So then let's look at the mathematics of it. Okay, so if you look into the spot pricing, okay, whenever you do the spot pricing meaning the then and there. So this is the equation. Equation here is that demand, global demand, then OPEC supply, then non-OPEC supply, then risk factor. Okay, so global demand, we know what global demand is. Global demand comes directly from the customer, what they want, how much they want, and all that, blah, blah, blah. So sometimes global demand for Saudi Arabia may be less. Why? Because India may decide to buy it from somewhere else. During the COVID period, because India was buying oil left and right from Russia, everything from Russia. Saudis couldn't keep up. So the demand in Saudi probably went down, right? And it definitely hurt Saudi GDP and all that too. I'm pretty sure it did. Why? Because to cope up with Russia, they will have to increase the prices of their oil, right? Even they may increase the production and all to meet the demand and to make up for. They say that to meet the demand, but actually they do all that to meet their GDP goal, GDP quota, and to minimize their deficit. Okay, so demand for one particular oil producer can be different each year too. It's not gonna be consistent all the time because it all depends on the major players where they are going to buy it from. But regardless, this is how the equation, the prices are controlled, or prices are how do I say it? Prices are determined. This P oil is the oil pricing in per barrel. Okay, But what's important here is to understand the risk factor. Risk factor is what actually uh, says that, hey, if oil price is going to go up or is going to go down. How risk factor is taken into account? Say adjustment for war, speculation, or trade restrictions, or sanctions, or something. But how all that actually translates into this thing? So how it translates is, I will give you a rough estimate. Okay, rough estimate is that supply chain. Okay, so what supply chain does is that, let's say because of war, the tankers have to take a different route. Logistics has totally changed, right? So sometimes it could be multimodal, then sometimes multinodal, or sometimes just single nodal, like that. Meaning the multinodal meaning that it is taking the ship, it's gonna then go to the railways, then it's gonna take the oil tankers, like that. But single meaning that only one means of transportation was used. Okay, so now that price went up, right? Supply chain price went up. Why? Because you had to travel the longest distance now. You have to take more time. So that went up, meaning that risk factor basically will come from there. By how much it went up. So nowadays what they have done is that they have these softwares that determine the risk factor, and then they put the risk factor here in this equation right here in here, and that determines it. But now let me explain this thing to you a little bit more. So if you look at it, then for a constant demand, global demand of oil, you notice that pricing is inversely proportional to the supply right here. Meaning that if supply goes up, pricing goes down, right? Supply goes up, price goes down. And if for a constant supply, meaning that let's say Saudi Arabia does not produce whatever they have supply, they keep it up, and demand goes up, then you notice that prices go up. Okay, so that's how it works. Now, if you have these things constant, demand and supply ratio is constant, and if risk factor increases, then you notice that risk factor definitely increases the price. So you have to always minimize the risk. All right, that's how the pricing is determined. All right. So so each and everything, like into 2022, OPEC reduced production, leading to higher global prices, right? But like I said, they reduced the production. They reduced the production because we both know why. And in 2008, hedge funds manipulated oil futures, pushing prices to 147 per barrel. Okay, so this is how manipulation is done. All right. Now, the futures pricing, how traders influence the prices. I have already explained this, how traders influence the prices. They influence prices by selling the securities, and those securities actually determine the actual pricing in the actual market. Meaning that, let's say I'm a drilling company, and I'm going to explain to you in a layman term. Okay, I'm a drilling company, and I just want to drill. I don't have money. I have $10, but I still need at least $60 to break even. And I want that $60 from somewhere. So let's say, then clearly I cannot drill. So what do? I go to the market, this market right here. I go to the futures market and I start to sell my securities over there. What do? They start to put... they call these oil bonds and everything, meaning that future security, meaning that when I will drill, then oil will be sold and then you will get the money, right? That's why lots of things are done in futures trading as well. For certain companies, futures trading works because they don't have the money instantly. So they want the money in future. So they tell their investors that in future, you're going to get this thing. All right. So they go and start to sell the securities like bonds or stocks or whatever. And then they get that money from there. That's what gives them money. And they take that money to go and drill. Okay. And then they, based on whatever they drill, based on the market and everything else, they determine the price using this equation right here. Okay. This equation right here. What is this? Future pricing, spot pricing. What is spot pricing? Spot pricing is, then and there I talked about it. Future pricing is in the future. And then exponential R minus Y times T. R is the risk-free interest rate. Okay. Risk-free interest rate. Then convenience yield. And then you have time to contract. Every time you want to determine future and all that thing, it will always be like this in exponential. Okay. And this basically, it comes from, I would say, differential equation. This is a mathematical model. So finally what they have done is that this model actually is, this is what you see here is a simplified version of the model. Okay. And see R minus YT. So if you look at it, hold on a second, I will explain you with this one too. There you go. So if you go, let's say if you form a graph like this, okay. So future pricing. So the graph is gonna be like this. Exponential graph goes like this, right? Exponential minus this. I can't even remember these things anymore. So it's gonna be, this is not gonna be exponential. This is not exponential. Exponential price goes up actually. Well, it can go up depending on minus or positive. So yeah. So hold on a second. I will explain you. Hold on. So because this is, you see the y right here, the x, so this is going to be positive, right? So positive meaning that, let's just say, and origin is 0 here, right? So it's going to be from here like this. It's going to be, graph is going to be like this. Okay. And this is P spot. So a P spot, this will be P spot right here. Okay. P spot. And this is going to be future pricing. Okay. This is going to be future pricing. The graph is going to look like this. So it will be a maximum price somewhere is going to be like this. It will never reach the maximum price though. It's going to get parallel to it. Okay. And so this is how you do. So what you do, if you lock spot pricing right here, then based on this equation and all, future pricing will be right here. Okay. Then you go up like this. So meaning that more you delay, okay, then higher the future price is going to be. So if you want best future price, then sooner you go and get it, that's the best price you're gonna get. Okay. Otherwise, what happens is it actually starts to get closer to the actual market price right here. The peak is the actual market price. Okay. So you understand this thing now? All right. This is how the graph theory works. Okay. So now let's look at this. So if the spot price of oil is $80 per barrel, the interest rate is 3% and the convenience yield is 1% for a 6 months contract. Okay, so equation, you put that and then you're gonna get the future pricing for it. Okay, for the 6 month contract. All right, meaning that you have logged in the price. Now this is how, for the next 6 months, this is how you are gonna get the oil. Okay. So this is how, guys, the whole entire oil pricing works. This is how the pricing is determined. So now you know, when all of a sudden a president or a leader or somebody goes and wants to have improved relations and all that, then there is a reason. But it's highly likely that reason is pricing. Okay, reason is pricing, and this is why President Trump has been trying to improve the relationship with Russia, because he knows that if he wants to at least bring things back on track as far as, inflation and all that is concerned, then you need to have a good relationship with somebody who can actually kill your entire oil industry. Now, why actually it has become even more scary at this point that President Trump has to, he has no other choice. I'm telling you, I can tell you this with a 100%, 200% guarantee actually, that he doesn't have any other choice other than to improve relationship with Russia. You know why is that? Because of the Arctic. See, Russia owns 80% of the Arctic. That's Russian land, 80% of the Arctic, okay? And that has massive oil and natural gas reserves, okay? So if they don't work closely with Russia to control the future oil prices and all that, I can tell you this, that Russians will have unstoppable supply of oil and everything. And future manufacturing in Africa, energy demand is going to grow. So Russians are going to actually hammer every other oil producer out of the market. Okay, that's how it's going to happen. So that's why Uncle Sam wants a good relationship with Russia at this point, because of this and this reason alone. Okay, so that's how oil prices dictate the geopolitics, or price of commodity prices actually overall dictate the geopolitics. All right. So what's going to happen in future? What's going to happen in future is that now, since everyone knows their place at this point, so what's going to happen is that you will see increased cooperation between Russia and US in the Arctic, because Russians want to maintain a good distance with Chinese as well, just like India does. Trade and everything is good, but at the end of the day, Chinese are going to Arctic, which is Russian land. They may start capture and everything. What Russians are going to do then? If China already claims certain Russian land its own, Chinese say that, oh, that's our land. So Russians have problem with Chinese. It's not like they don't have problem. It's just that they're forced to be on their side because they have no other choice but to. Okay, so how future is going to play out is that all the major players will be in the Arctic. Okay, all the major players, and India will be reaping the rewards of their hard work, and India will be controlling the Indo-Pacific. Okay, so India and the West Asia, they are going to work together to control along with Israel. So that's why Israel's firepower is needed. Okay, that's why in that region over there, and then in Mediterranean. Okay, and then Iranians will be there too. That's why India is not ruining relationship with Iran too, because you need these players in everywhere. It's better to have a good relationship rather than go bomb Somalia or Yemen and all that and waste your money into all that. Because people who have nothing to lose, they will continue to do what they have to do. So it's best to work with their handlers to tackle the problem with the price. All right, guys. So this is it for me, and it's almost one hour. Can you believe this? Just for the oil prices. This is why I wasn't doing the whole thing. Okay, so I hope you guys enjoyed it. Please do like and subscribe, and I will talk to you guys in another video. Thank you.